Bring this back to the wider token ecosystem, because something we've experienced is most people cannot clearly distinguish between tokens in the space, which is a problem for adoption because people associate a security token to the ICO token cousins. So just as a kind of overview probably for most people here, you have the payment tokens, which are the first type of tokens coming into the market. That would be Bitcoin. In the case of real estate, that would be I'm using Bitcoin to purchase this property. And it's more of a means of payment. You can also obviously have a stable coin, using stable coins to purchase properties that can be linked to smart contracts, but it's not something you're building off of. Then with the ICO boom, you're creating utility tokens. Those need to act more like an access to a product or service. People can relate them to, say, a gift card for a certain type of Starbucks. You can use it to access your Starbucks, or it can be a product license. And that was what the majority of fundraising was. The issue was, how are ICOs regulated? And a lot of the questions around regulation exist more in utility tokens, because what specifically qualifies as a utility token is still ambiguous. Real estate tokenization falls under the security token wrapper, which is what this event is based on today, where that they're fully regulated. So you're not skirting around the laws. Your security tokens need to exist within the existing laws. And so people will say there's questions around regulation, but for a compliant security token, you don't want there to be questions. You want to look at the existing regulation, and that's all part of your issuance. And so Leaseum would be classified as a security token. Why does it actually matter, and why is it coming into this question around how things should be regulated? So back in the early days of blockchain being developed, it kind of existed as this world of cyberpunks, and people weren't sure how exactly it would play out. But the DAO did one of the largest crowdfunding of all time of 150 million that brought a lot of attention. It brought further attention when 50 million, or about 30% of that fundraise, was hacked due to a bug in the source code. When this happened, the SEC started paying attention. It got further brought to light over 2017, 2018, when billions of dollars were raised for ICOs. And how are they actually classified as securities? So a lot of ICOs were actually just unregistered securities, which the SEC didn't like and isn't sustainable. You've now seen a lot of those have lost, have essentially become worthless. Their money will become up and down in space. So why tokenize real estate? So these are the major benefits, and I'll go into each of the major benefits in a little bit more detail. So first of all, cost reduction, fractional ownership, a wider range of available investments. If you think about the way you can invest in real estate today, perhaps you can buy a single building, but can you buy a single building in XYZ country where the market may be interesting for you, and how does that actually happen? Likewise for funds or REITs, what is actually available on those markets for you to invest in? Then you have a larger investor base of who's able to access these investments based off some of the benefits is a lot bigger than you're going to have for a traditional real estate type vehicle. And then hopefully with all this, you're getting an enhanced liquidity. So going into the cost reductions point of view, from a transactions cost, there are various moments you can save money. An example would be for dividend payments. You can have the dividend payments programmed directly into the smart contract. So when you're required to pay out the rental income dividends to your token holders, that can be coded in, saving you money on the transaction cost level. As well with the issuance cost, creating this more public vehicle, it's a lot cheaper to do a sort of security token offering for real estate than say an IPO or something else to get on the public markets. Custody is quite interesting. So because security tokens are based off the ERC20 token standard, people who are holding these registered assets can do self-custody in their Ethereum wallets if they want to, which makes it so that they're personally in charge of holding the custody. And it's also a little bit safer than for an ICO type of custody, because if you lost your private key in, say, a Bitcoin or Ethereum transaction, it would be very difficult to redeem that, essentially impossible without finding a private key. In the case of a real estate-backed token, because of the process of the issuance, you would be able to prove who you are through your KYC and AML and get access to that token again. And then compliance, I'll go into a bit more on the next slide. So looking at how the compliance actually happens on the blockchain, we're gonna go through an example of a real estate fund, because that's what I'm most familiar with. So with a fund, you as the issuer, you want to be confident that everyone who's purchasing your fund is legally allowed to purchase your fund. First, in primary issuance, there'll be different regulations. So if you're, say, a Reg D offering out of the US, that would require you have KYC, AML requirements, as well as accreditation for every single investor. So that can be done through a process of whitelisting people's Ethereum wallets. So each of the requirements for your specific offering are attached to their wallet. If you're the case of a REIT and you have maximum number of investors, that could say you have a max 2,000 investors who can hold this asset, and then that gets embedded in. If I, the purchaser, want to purchase the token, I essentially get blocked on my purchase until I pass each of the accreditation requirements based off my offering. And that can exist separately. So in our case, we're a Reg D offering for US investors, but non-US investors have different regulations associated to them. And for US investors, they don't need the accreditation requirements, and so you can have the wallets programmed. That also creates the secondary market opportunities. Me, the issuer, I can continue to feel confident that in the secondary market trading, if someone tries to purchase my security and they don't pass the requirements for my offering, it'll get blocked. So on a wallet level, when they're sending their payment for the security in the secondary market, they'll send it, and if their wallet is not approved for our type of offering, it will go back, and I have to wait for their wallet to get approved or to find a different buyer who does match our regulation. Any questions about the compliance level? So in fractional ownership, this gets spoken about a lot in real estate tokenization. And so what it does is it enables you to acquire assets you would ordinarily not be able to have access to, whether that's an iconic building, it could be, say, a sports stadium of your favorite team, or a real estate fund. I put these buildings here, but I also want to take a step back, and just because you can buy something doesn't mean you should buy something. So if, say, the Empire State Building has a security token and it's giving you a 5% yield per year, but the building right next to it that no one knows the name is returning 8%. Maybe there's like an emotional attachment to have the Empire State Building, but also think about what's the return, what's the actual investment, and why should you own that investment, not just the fact that you can own it. For real estate funds, it creates more opportunities for smaller tier investors. For private equity real estate, traditionally the minimum investment sits around $1 million. With the tokenization and automated compliance, you're able to accept investors who are, say, giving $1,000 in primary issuance, or in the secondary market, someone could access that from a $1 point of view, assuming they pass the requirements for your offering. All of this is developing like a broader target market, which helps with the diversification effect of real estate. You want your real estate to match the value of the underlying real estate as to help against other market effects in your portfolio. And when you have more different types of investors, that then they behave in different ways in different market conditions, further helping you as your overall diversification risk. So on the institutional side, that can be institutional investors we're traditionally seeing going into the commercial real estate type vehicles today, but also crypto institutional investors, which is a new class. A lot of them will be going into more risky investments, but some of them might want a more safer, like steady growth type of return. So an example is ICO companies. Say a company ICOs and they raise 10 million using Bitcoin or Ethereum. That can be incredibly unstable, and it's hard to grow a company on that kind of instability. So they could convert into a stable coin, but another movement to keep their money relatively stable in the sense of as stable as the real estate is they could convert the money they raised into real estate backed tokens, providing them steady growth, but not the instability that they're seeing in Bitcoin or Ethereum, and keeping them within their overall ecosystem. From a more smaller retail investor point of view, again, you're able to help that with both the fiat investors. They get access to types of investments they are not currently getting access to, but then also the more crypto-based retail investors. It's again a more stable wise to protect their crypto holdings. So all of this coming together, it helps move this really illiquid class of real estate and bring it into more of a high liquid type of market, more similar to public securities. which is interesting because you don't have to find necessarily an entire buyer for the building. In the case of a closed-end fund, it could be a 10-year closed-end fund. The capital is staying locked up, but the investors are able to change. You're able to exit at year 3. From a retail investor point of view, that's really interesting because it could be that you want to purchase a home or there's a medical emergency or various things that made it so you couldn't invest in an entirely illiquid investment class previously, and now you're able to access this type of item. So the entire ecosystem of real estate investment and what you can do. So first, you have the traditional direct investment. That's you directly purchasing a house. It could be that you directly purchasing a commercial real estate building. Access to opportunity depends on kind of deal flow, what you're seeing. But then there's the wider indirect investment opportunities for real estate. And that can exist both for the unlisted funds, so let's say a private equity real estate fund where you invest through them, or listed funds, which would be REITs. The disadvantage of REITs would be their ties to the equity markets kind of limits their short-term diversification traditionally, while private fund performance will often be stronger than that of REITs. So the tokenized funds will exist in between this indirect and direct or the unlisted and listed funds of indirect real estate investment, providing you various opportunities. So it's a lower minimum investment. There's this enhanced liquidity from what you see. The performance can be a lot stronger, so you have options to higher returns than you currently see. A downside is that it's an emerging ecosystem, which I can go into in more depth kind of later. So a case study, so what's my involvement in this? How's it going together? So Leaseum Partners is a tokenized real estate fund. And so in our specific case, we're a 10-year closed-end fund that's an income strategy. We're paying out dividends from rental income. And essentially, investors in our fund have the option to receive their shares as digital tokens to receive this potential liquidity down the line. The portfolio invests in New York City real estate. I have a slide on the team, and the main point around this is for anything you want to tokenize, it always depends who you're actually working with. And so how can you actually raise money? So we're raising $250 million for the fund, and that's based not off the fact that anything is involved with real estate or involved with blockchain. It's based off the real estate. So if you're investing in a fund, you're investing in it for the same reasons you've always been evaluating fund investments. You're investing off the portfolio manager, you're investing off the market they're investing in, you're investing off the governance. All of this is put together. You still need to read all the same legal documentations. What is their PPM saying? What's the investment strategy? This isn't forgotten about, and I think sometimes with blockchain, sometimes it gets exciting that it's a token, but essentially it doesn't matter if it's a token. It matters who the real estate is. But when you do combine these things, you create a really interesting opportunity because you're able to take benefits of multiple worlds and combine them. So in the case of real estate investment management, there's a lot of reasons why long-term people want to invest in that. It's much more stable, it can hedge against various inflations, it helps diversify your portfolio. And if with the right team, you can see the track record, you can see what kind of assets, you can see their traditional IRR, and that's the reason to invest. Then on the blockchain side, you're getting these smaller ownerships, you can exit faster, there's new benefits being enabled by blockchain, and this all comes together, and so you're able to get the best of both worlds. But there are a lot of challenges, and so are people familiar with this hype cycle graph? Yes. So putting real estate tokenization on the hype cycle, I would probably classify 2017, 2018 was this peak of inflated expectations when people thought blockchain could solve any problem for anything. And then a lot of the market crashed, it all went tumbling down, and it realized transaction speed was still really slow, a lot of the infrastructure wasn't there, and it wasn't quite ready for these big promises that I've been making to everyone. So my hypothesis is that we're somewhere coming out of the trough of disillusionment for real estate tokenization. It's still really, really early, and it's an area, as you learn more about it, the actual more early you realize it is. You can live in a bubble of thinking people know about it, but actually most institutional investors don't really care anything about blockchain. They just want to invest in the real estate. Most people you talk to really associate these real estate-backed tokens to the unregulated ICOs. You may notice a lot of people call security tokens digital assets, digital securities, lots of words, avoiding crypto, avoiding token, because it creates negative emotions from the ICO past. So the major issues, lack of education, just enough people don't understand how it works. They think it's riskier than the underlying real estate, when actually the risk is the real estate, not so much the token. Infrastructure is still very, very early. So a lot of the things you need to make this whole ecosystem work are just not ready. For example, institutional custody is not really there yet. How are institutions able to receive tokens, even if they're fully regulated? This type of custody provider is not really there. Specifically, issues on the infrastructure is on the secondary market exchanges. There's a handful of exchanges who are live. So you've T0 is live, Open Finance is live, Shares Post, and I think maybe one or two more. If you look at the trade volume of what's happening on those exchanges, it's very, very low, and it's not actually this promise of magical liquidity. And kind of where the liquidity will come from depends. Regulation tends to move slower than technology. So technology for real estate tokenization can do a lot of things, but regulation prevents that. So an example is you could have it set up that you can pay your rental income dividend payments on a minute-by-minute basis, because that can all be recorded. But from a regulation point of view, you need to report back to the regulator the ownership and the dividend payments. And it just makes this an unfeasible potential to actually provide a minute-by-minute dividend payments. And there's lots of little issues like this where you go into the details, and it can do it, but it doesn't fit with the way everything's currently built. And then finally, and this is the issue, we need high-quality assets that are being tokenized. Again, if people who have strong real estate in good markets where you're going to see a strong IRR, if those types of projects are not tokenizing, it doesn't make sense, because where is the liquidity coming from if it's not a strong asset to begin with? Why would someone want to buy like a flat piece of real estate that won't develop the market? So you need people with strong real estate assets to actually want to enter this market. That being said, there is hope. The whole landscape is emerging very, very quickly. If you think security tokens as a term just started being spoken about a year ago, a lot of major institutional finance players are moving into the space, whether it's custody provider exchanges, and they're building out the backbone of this. So we're seeing custody solutions, we're seeing exchanges, we're seeing cap table management, all coming up from big players. You're seeing more stable coins enter the market. So it's all happening, but it's still very, very early, and a lot of the promise still exists in the future versus in the current world we live in. So that is everything. Thank you, and does anyone have any questions?
Yeah, so when you talk with institutional investors who are used to investing into these types of funds,
yeah.
So what's their feedback regarding actually having a digital security or security token?
Yeah, so we're a $250 million fund. $200 million is purely institutional money. We don't even tell them that we use blockchain most of the time. We essentially do our entire pitch discussing our portfolio manager, whose family has about $10 billion under management in New York. They are interested in that. They're interested that our chief investment officer spent most of his career at Aviva Investors. Maybe we'll, at the very, very end, include a slide on blockchain. Sometimes we don't even do that. For institutional investors, because they don't have custody, almost every institutional investor, we're issuing traditional shares with the option for them to convert to tokens in the future. But again, like, they've already decided to invest at that point. They're not ready for the tokens, basically.
So the potential secondary market is not the major issue for them?
Yeah, I mean, they're just interested in the real estate, because if they do any kind of due diligence on the secondary market, like, where is it?
And regarding the secondary market, are you actually exploring the options with Open Finance, T0, or some other players?
Yeah, so we've spoken to essentially every single security tokens exchange. They're all just very, very early, which we think is fine, because for one, our tokens have a 12-month lockup period for US investors, which will probably extend to all investors just to kind of keep ourselves safe. And then for, say, a private equity fund, we have a 2-year investment window after fundraise to actually invest into the real estate. So why would you sell your tokens before it's actually been invested? I think the liquidity makes sense kind of starting on year 4, year 5 maybe. But why would you sell in a closed-ended fund at year 1 when you're still just investing in the assets? And so you need to think about, like, when does it actually make sense to have the liquidity? And I think by the time people are ready, the market will be ready.
And a quick question regarding the technology itself. So are you using ERC20 compatible or some other blockchain network?
Yeah, so I think it pretty much makes sense for all security tokens to use ERC20 right now. I think there's a case for Stellar, but most of the infrastructure seems to be being built first for ERC20. And so until there's a more like robust infrastructure for a different token standard, I would recommend ERC20. Cool. Yeah?
Sorry, maybe I didn't get this right the first time. So are you actually building on top of ERC20 for this, for your assets?
Yeah, so essentially, I mean, this would be any security token, not just us. We are ERC20 based, which is like, if you think of a credit card, how a credit card looks, just making you to the standard of all credit cards. But then you have like essentially a blocker on the transfer mechanism, which is the compliance check. So for our specific type of offering, that would be a blocker to have your KYC, AML, and accreditation. We also have like REIT requirements. So I think we have 2,000 max investors in the US. So there's different requirements we need to put in place.
Right? That was it?